Radhika Rao, India Economist DBS, now joining us here on Markets at noon. Radhika, good afternoon. Nantara Rai in New Delhi. You know, we're talking at yields being at a 2016 low at a time when, there is still so much fear about NBFCs. Look at the kind of news that is coming out from housing finance companies, NPAs, more and more corporates perhaps going down the IBC route. But on the other hand, there's good news when it comes to inflation, global crude oil prices, the budget provision as far as the foreign borrowing goes. So how realistic is it, the Mint Street expectation that there should be a rate cut even when there is such a lag in the transmission?
Hi, good afternoon, Antara. So certainly, I think these are two aspects that the markets are viewing very differently. From the macro perspective, you've seen that the positive catalysts are very much at play. So you rightly mentioned inflation as being number one. Subsequent inflation numbers have been ticking higher. But what's interesting is that headline is inching up, but the core inflation is inching down. So to some extent, the higher core inflation has been, catching down with the headline inflation, and you've got inflationary expectations that are also look pretty much anchored. Now, with this scenario, it basically lowers the hurdle for central bank to go ahead and ease rates. One sticking point was the fiscal bit. You've seen the central government not only meet expectations in terms of the deficit target, but rather signal that there could be a 10 basis point improvement in fiscal consolidation. Now, this basically plays into the larger discourse that, with growth on the slump, it is better for the central bank. Rather, it opens up the room for the central bank to take up monetary accommodation. And that's why I think they have already done 3 rate cuts so far this year, and we look for another 50 in the rest of fiscal 20, with the immediate one likely in August. Now, I think the stresses in the non-bank space and selected HFCs, I think is more evident in the spread between where the GSEC is and the borrowing costs are. I think that is where you would see the stress being very evident rather than challenging, the monetary cuts and the transmission. And the second bit is that liquidity, which had tightened quite strongly before the election, that's the other bit that is turned favorable now. So we do think that, yes, transmission happening with a lag, but I think it will be much more now than perhaps the first 4-5 months of the year, which should take at least one scope of worry away for the corporate sector as well as borrowers in the bond market. But that said, yes, I think insofar as monetary policy is concerned, good news, and as the case globally, where weak data turns out to be positive for the markets because it means all authorities will have their hands on the deck and try to shore up growth. That's the same case that's playing out right now in our market as well. And from that angle, I think 10-year G6 have some more room to decline, essentially because I don't think we have reached the end of the rate cutting cycle as yet.
Okay, so Radhika, if I could carry on that conversation, because then are you basically saying that what we are seeing on Mint Street may be a rub-off effect from global events?
Certainly. You see, I think there is a sharp contrast between how second half of 2017 and 2018 vis-a-vis where we are at this point. The commentary globally, even about 6-8 months back, was about which central bank globally is going to be ahead of the curve in terms of tightening. Fed had already tightened rates. The European Central Bank ended its QE, and it was only a matter of time before they had considered hiking their rates. At one point, the ECB governor had also mentioned it could come as early as this quarter, the second half of 2019. And then you had Bank of Japan, who were also likely to take advantage from the fact that the other global central banks are hiking rates as well. Now, that narrative has completely turned on its head. Now, as you have the global markets talk about, carry dovish undertones, you've got global yields that have corrected very sharply. That provides a lot of breathing room for the Asian central banks. So essentially, not having to follow the Fed up, they can look at their own domestic catalysts. They can look at how inflation is going and how growth is sparring. And growth, honestly, has also been weak. Of course, from India's perspective, it's been weak, and it's weak globally, Asia-specific as well. So growth momentum continues to slow. And insofar as inflation is nowhere near target, it provides a lot of room for policy stimulus to be stepped up. So I think RBI has done much more than the rest of the region has done, but nonetheless, you've got to the likes of Malaysia, Indonesia. We do expect a cut tomorrow, and then they've got other regional central banks that have already jumped onto the rate cutting bandwagon. So the change in narrative, I think, helps the regional central banks, and insofar as their domestic growth inflation dynamics showed that yes, they could go ahead and ease rates, most of the central banks are taking advantage of that situation. And I think given growth slowdown, particularly from a weak external sector, monetary accommodation seems to be the only way to go for the time being, at least.
Right. Radhika, what do you make of the sudden drop in the rates? I know you have spoken about the rates, what central bankers are doing, but I wanted to ask whether markets are factoring in higher liquidity or markets are factoring in lower growth.
I think there is a connection between the two. So as growth slows down, particularly, let me take a global perspective again, as growth slows down, you've got central banks who are in some way trying to be preemptive to say that, if growth does surprise to the downside even sharply from where we are at this level, they could even consider restarting asset purchases. And again, as far as European Central Bank is concerned, only in December they actually stopped buying. So Jalan onwards, they haven't been buying assets, sovereign bonds. So now they're telling you that if growth continues to slow down, I could come back to the market, I could set up, renew QE, and that in turn means liquidity will be flush. And usually when you have flush liquidity and rest of the global market, yields assets or debt that is yielding negative returns or negative rates is at almost $13 trillion globally. Now, that being the case, and you've got flush liquidity, then I think you will have again this opportunity for investors to park their funds in relatively higher yield, and that's why I think you've seen debt as well as equity flow to this part of the region, particularly Asia again. So I think slowdown in rates correction is led by slowdown in growth, which in turn, so there is some kind of cycle here, which virtuous cycle, so to speak. When a slower growth means the central banks are ready to do more, which means heightened liquidity, which again means that asset markets are doing well. So like I mentioned earlier, as far as there is weak economic data, markets are looking at it in a positive lens, and I think that circle continues to play out. So there is a stark change between 2018 and 2019, and I think that is what has provided, again, downside to many of the regional as well as global rates.
Right. Radhika, also, we have the Jalan committee meeting, probably the last one today. What do you think the bond markets want to hear from that?
Certainly, I think if we were to look for what will help would be indications that the central bank should set aside higher sum of dividends as a contribution to the kitty, to the central government's kitty. That would be taken as a positive. If we were to look at the fiscal 20 math, the RBI's dividends to the government is pegged at about 900 billion. June, July is when usually the central bank usually winds up its balance sheet for the year, and then you have the announcement for the dividends. So certainly, any indication that the central bank will, has the room to set aside more for the government will be taken as a positive, which means that revenue support will help keep to the minus 3.3% deficit target. So that is the one big announcement that is awaited. On the other hand, if there are signals that this still remains to the discretion of the central bank and that there might not be much cash outgo, would be construed as a negative. So certainly looking at this announcement very closely, and close to this would also be the other one where the liquidity framework announcement is due that the central bank governor had announced back in the June meeting, and at that time they had said that it could be anywhere in the second half of July. So I think these two announcements are certainly being looked at very closely.
Right, Radhika, thanks so much for that.